What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. This episode is a weekly recap of what was going on last week. So we're going to be looking at some weekly charts, mapping out some key levels, following up on some previous videos. Sorry I'm getting this out on a Sunday. Me and my wife are traveling on a little vacation right now, but I still felt that it was important to come on here and get some of this content out. Today's date is March 7, 2021. Let's go ahead and hop into today's episode. All right, welcome back. So Friday we saw one heck of a run in the indices. We're looking here at the sectors. You can see 8 out of the 11 sectors finished in the green, with lagging technology sector, real estate, and consumer discretionary. You can see here this is a period of 1 week. This makes sense because of rising yields, right? And the market pricing in higher inflation. So you can see here energy leading the way, also due to oil really seeing huge moves throughout the week. And then also the financials really benefit from higher yields as well. So energy sector up almost 10% for the week. And we've been talking about the energy sector, and it still looks like, there's a lot more to go within that sector. So we got to be on the lookout for that. Now, also, we had a stronger than expected jobs report, which could have helped also the Friday boost there that we saw in the indices. From a relative rotation graph, I just really kind of want to point out these three sectors. We've got the XLC in the leading and the XLF and XLE. XLE did start turning up. We're looking at a weekly time frame here, and you can see we have a couple laggers down here like XLU, XLP, kind of turning up though. So this really just helps us to kind of get a good visualization of, is it improving? Is it going more towards leading, weakening? And the more it goes into these corners, the more stronger that sector is from a relative performance standpoint. Now, you can see here, energy has just been the strongest one, closest to the leading corner right up here, and starting to uptick too. So really finding those energy stocks have been quite beneficial these last 3 months or so. Let's go into the indices. Okay, we're going to be looking at multiple time frames. Then we're going to get into some stock market indicators, the dollar, and then also yields, and then wrap it up with a conclusion. So let's hop into the Wilshire. The Wilshire, what I want to call out here, you can see that big bounce on Friday. Really, the range of the candle looks very similar to the previous day, and you can see just all these candles right here in this, from March, just before March right here, large range candles. This could be potentially more of a distribution thing, while the bears and the bulls kind of fight to take, I'd say direction, to try to find direction. Now, overall, we bounced off the yearly standpoint here from 39,400, and that was the yearly open for 2021. So that is acting as support, and you can see over here it did the same exact thing right here, found some support. So this could be, a short-term double bottom, and we might see continuation to the upside. But what I want to call out here is also on the shorter time frame, this daily time frame, we had the moving averages all crossed over, so we haven't recaptured that. So this is still technically short-term bearish on the daily time frame. If you do zoom out quite a bit, it is overall in bullish context, which I don't have the weekly time frame on me on this one, but what I wanted to call out, which I'll show you on the other charts, unfortunately I posted the same chart here twice, it did bounce from the weekly 20-period moving average. Now, when we get into the S&P 500 on the weekly time, you can see right here, it bounced around on the 20-period weekly moving average, and that was actually one of the only tweets that I posted on Twitter during the day, during the week, really, from a technical kind of alert. And you can see here on the 30-minute time frame, I said both September 2020 and October 2020 corrections, they pulled back in the 20-period weekly moving average and bounced. So I said we're currently $4 away, and I said that right here on this 30-minute candle. And clearly, we bounced up. We found that resistance the following day, right? And we came back down. It looked like it could have been a dead cat bounce, but you saw that really pick up there. So right here, did find a temporary bottom, this is one of those support levels that we kind of mapped out to, 372 all the way down to 368. From the daily time frame perspective, you can see that the yearly open did hold as a support for so far. We got right back above the 50-period moving average, and we're kind of almost within this channel again. So we might be getting back in this channel. I still think that if we break through this red line, that 3,900 kind of zone, easy target would be 4,000, and I'm still kind of holding to that one. But overall, you got to understand, the price percent oscillator is still heading down so far, okay? So it's still in bearish, short-term bearish context. You can see these large range candles mean that there's still a lot of drama, a lot of emotion in the markets right now trying to catch its legs. Overall, when you scope out, though, it is still in bullish context, right? You have the 20 period above the 50 and above the 200. Yes, we have a bunch of gaps below us. All these gray shaded boxes and gaps typically get filled. So we still might be, in the start of a topping process. It's very possible, especially if what the Fed does is completely just kind of ignore, at least, quote unquote, ignore when they talk these rising yields. So my personal belief is I think that they're waiting to respond to how the market responds. So they're more going to react after they see what takes place. But I think that they're not short on tools, and they have the idea of what potentially could happen. It could be some form of yield curve control or Operation Twist to suppress yields from continuing to rise. The higher that higher yields go, right, we're pricing in higher inflation. You can see that in the oil prices there as well. So just some interesting price action overall. I already called this one out, but the weekly time frame, we from peak to trough, we went down 6.1%, tapped on the 20 period weekly moving average. This candle right here is a doji candle. This represents indecision. So we really opened the week here, had a crazy, volatile week, large range candle, and we closed right where we started, right? So we're up overall 30 points, 0.81%. So very interesting price action, still held that 20 period, and you can see here these previous times that it pulled back into, we saw some rallies from that point and over here too as well. So this could be just very temporary. What I want to call out is the I keep saying MACD. Price percent oscillator is a bearish crossover from up here, so we need to be very mindful that this could be the start of a potential turning process. However, the market did bounce pretty strongly there on Friday. So we'll see if there's more legs to that bounce coming next week. Let's look at Dow Jones. Structurally speaking, this is a rising wedge, not the greatest looking pattern. And you can see here that this trend line did hold, this lower trend line, still above the 20 period weekly moving average too as well. We didn't even tap down on a 38.2 retracement level or the 61.8, but those were some key levels that we mapped out on previous videos if this were to start breaking down. And we got to keep an eye on those. So this is just coiling very, very tightly. We can see we broke through that resistance once and then got quickly rejected. So we tested it once, and you can see here it's support, and now it's acting as resistance here. So it's going to be interesting to see how this one plays out. Perhaps nothing comes from it and we continue to move higher, and then we got to start re-looking at some key levels. But as it stands right now, we are still coiling tighter and tighter, and it can get very nasty if we start breaking through this trend line and start heading lower there on the Dow Jones. On the daily time frame, we need to really recapture 31,750. You can see here we had resistance all throughout here. We had this little bull trap, came up and then quickly got rejected, and then we've been struggling to get back above that 31,750. We did hold the 50 period moving average, so you can see here we came down, bounced on the yearly open, closed at the 50, and then we had that follow through day on Friday. Price percent oscillator does look like the histogram's ticking up right here, so it does look like it wants to have somewhat of a bullish crossover. We will see. Now, when we get into the indicators, I want to call out that the indicators, some of the ones that we'll be looking at, suggest that there's more of a bounce to come, okay, more of a rally to come, and we'll get into that here soon. But give me a second. Nasdaq came perfectly tagged into our target, 23.6% retracement level on the Qs, and they closed right on the weekly 20 period moving average, so that is currently holding. We'll see if there's more downside. We've been seeing a pretty weak overall, 1.74%, so almost 2% down on the week. This is, in my opinion, due in fact because of the 10-year rising yield, which suppresses these growth stocks, and you can see this rotation into value where value outperformed growth. So keep an eye on this one. Keep an eye on the 10-year. If we start breaking down through this 23% retracement level, I think 38 would be that key hit there on the weekly time frame, which would make sense also if we look at it from a daily perspective. This was what we mapped out as far as a target area on the daily perspective, right? We had the head and shoulders. We broke the neckline, which was at 38.2, and we said we drew out this little pink box right around the 50 and the 61. So we came right into the center of that, which just so happens to be right around where the September peak was. and we saw this big hammer candle. So is this hammer candle going to have follow through? Well, to have follow through, we had to get back above the 38.2 retracement level and hold that level for a couple of days to know that this bounce has some more momentum to the upside. And then, that would suggest that this head and shoulders was just a fake out. However, keep in mind, if we do continue to break down, we're looking at this range right here, this open gap to get filled right around the 200 period moving average, and that puts us right around that 275, 280 level, which makes sense from this perspective. You can see 271.57, that 38.2 retracement level on the weekly time frame. So it's important to match and watch these weekly time frames. As you can see, they do line up quite well. Now let's look at the Russell 2000. Structurally speaking, not the greatest looking pattern, right? So rising wedge pattern, you can see just this vertical move to the upside. And we know what happens when you get vertical moves to the upside. Like we saw this in Tesla. One of my predictions on Twitter for Tesla for the year, I posted early January 8th, I think it was. And I said, it hasn't reached its all-time high. It has potential to go higher. We're going to see a 40 to 50% retracement, and it'll probably close lower than what it was currently at. And we saw that 40% retracement level. The pattern itself looks structurally just like this, this vertical line going straight up. So we got to be mindful of that. The RSI is at a bearish divergence, bearish pattern, overall bullish context, okay, because it's been going straight up. And then price percent oscillator does look like it wants to have this bearish crossover. We pulled down into the 13-week weekly EMA. I didn't update this to the 20 period moving average, but you can see right here we tapped right on the 13 week, which is another important one on the weekly time frame. If we start breaking through this rising wedge, I'm still targeting this pink box. That's just an excellent opportunity to catch a bounce. Now let's look at the IWM on the daily time frame. It's been trading within this channel. Price percent oscillator still flipping down. I'd say if we start breaking down through 205, then we're putting in a lower low. Okay, that is bearish. This could be a left shoulder, head, right shoulder building out. We don't know that yet. Overall, though, context is bullish. We have the 20 period above the 50 and above the 200, and the 50 period moving average is currently holding. All right. Now let's get into some stock market indicators. We're going to start with the CPC. The sell signal did trigger, crossed all the way through. The 10 period moving average on the sell signal is now at 82. So that means, we saw this when it hit 80, and that was a sell signal, and we saw those downward pressure to the downside. Do we think that there's going to be more selling pressure? This suggests that it's still a possibility, but we don't know for sure if that was all we had as far as selling pressure, right? It doesn't tell you how far the drop would go. It just tells you when to pump the brakes, and it was very accurate finding that when to pump the brakes. When we did cross over previously to the upside through the red line, you can see that it kind of traveled around sideways and then fell further. Same here. It actually went up a little bit and then fell further. Right here, you can look down. It actually went sideways to up and then down as well. So this could be the start of a bigger move to the downside. When we get above the green line and then cross back below it, that is typically that quote-unquote buy signal. We'll keep an eye out for that, but as it stands right now, I probably won't be needing to show this indicator much more frequently, just because we know now we got to be on our toes a little bit. From a VIX perspective, look, a big down day on the VIX. Friday is typically, VIX crush day. So the VIX gets crushed on Friday. So this could be just, a fluke right now, seeing that big day on a Friday, being aligned with the jobs numbers, better than expected, and then also being VIX crush Friday. You can see just a big, huge down day, down 13%. This helped fuel, obviously, the rise there in the S&P 500. And you also saw that in the other indices as well, but we're still relatively high, right? At 24.66. So we're right at that key level that we've been kind of watching out for, where it's been battling back and forth. I think that if we start breaking above this 32.5, we can easily come tag the top of the target, this top of the channel. And then if we start breaking through that, we got to be very, very careful, because we can see some big momentum to the downside like we saw in February and March. But we're right there in the middle of the channel. If we start heading lower, I would expect that we can start taking profits on certain trades more around this lower end of the 20 range. And then if it gets higher, that's where you typically want to start looking for opportunities to buy those dips. Just because it makes for a good risk versus reward. The higher this goes, the lower the market goes. And every time that it hits in this upper range of the channel, presented itself some great buying opportunities. Now, what I did say earlier was I said, it does look like, some of the indicators are set to potentially move the indices higher. And I'll show you the BP charts here and what I mean. So first off, BP NDX. This suggests being oversold here on the BP NDX RSI with a positive divergence. This suggests that there is room for the NDX to bounce. And that would make sense. Why? Because they've been pretty much getting hammered. So this does here suggest that, hey, the bounce can continue. This is not an area where I'd actually want to short, simply because we're in oversold territory on the BPNDX. BPSPX, we drew this out last week or early last week or maybe the week before, where I was looking for the opportunity for a potential positive divergence here on the BPX chart too as well. So this one's not quite there yet, but if this heads just a little bit lower and this gets into oversold territory, that would be a bullish divergence here on the BPSPX, which would also, to me, suggest, and you can actually technically call this a bullish divergence here. If this is pretty much flat right here, and then you have definitely a higher low here versus this one. This could suggest that the BPSPX is in the early stages of a bounce. So I'm keeping an eye out for that. That's what the charts suggest here, but not all of them. Like I said, the CPC, but this does suggest that we are, we can bounce. The BPINDU moving into that oversold territory as well for the Dow Jones. So this also suggests that we can potentially bounce. You can see it came into oversold right here. If you just move up here at the beginning of February, what happened? Well, we moved right up to making all-time highs. So keep an eye out for this. Okay, if people are shorting into these oversold territories and then they catch a bounce and then all of a sudden they have to cover at the exact time when it might continue to roll over. So things like this can get very, very complicated and complex. Got to be very tactical. Here's the lumber to gold ratio, 13-week. It's still way above zero. Kind of upticked a little bit right here, just kind of curving out. So risk on still on this specific indicator. We're lumber to gold on the 3-week rate of change, which, it can be wrong more frequently. It can be right early. Once it hit down here in, mid to late February, hey, that was perfect because we saw the move starting to move down. So that signal was perfect as far as spotting more volatility to come. It is still below zero, so it still suggests on this shorter time frame that we need to be careful out there in the markets where it's a risk-off environment. So we have some conflicting things, right? We have some charts suggesting that we're prone for a bounce. We have some charts suggesting, okay, be careful here. And this makes sense because you can see indecision on the weekly closes, right? They're doji candles, so that creates indecision. And then also these large ranges, which suggest high volatility as well. So, from a technical perspective, it makes sense to see these charts kind of wonky like this. And then we had the NIMO. We called this big downpull right here a little bit of an overextended move. You can see where it bounced here, and we saw moves to the upside. Now we're at 23.97. So poor breath for a pretty big Friday overall. So minus 23.97. We saw that bounce. Are we going to see continuation? Well, that bounce didn't really suggest that we had the greatest breath moving into it. From a finding the bottom standpoint, this is the Kohan. I brought this on one of my popular market briefs that I did a big picture stuff. I think the thumbnail said critical on it. And this really helps us find market bottoms pretty well. So you can see in overextended territories like here in 2016, 2019, and 2020, you can see it reached down to this red line, very overextended, and that was tagging those bottoms pretty spot on. So you can see here, still room to go down, but it's going to take some real thrust to bring this all the way down to there. So I'll keep an eye on this one just in case the market continues to roll over, and I'll show you, when we get into these overextended sold territories, but we're not there yet. Here is the NIM. I just want to see what asset managers are doing. And you can see here we had a little bit of uptick on the RightX, and we had a down move here on the NIM, which is printing just above 60, quickly moving down. That suggests, right, we're max exposed to the downside up here, meaning they're using above 100, means they're even using leverage, and they're just max long. Now you can see we taper that back a little bit right above 60. And you can see right here on the RightX, we uptick just a little bit, but still very, very bullish sentiment there as well. All right, now let's hop into commodities. This is important. WTIC been on a monster tear on the weekly time frame. We did break out of this, 2-year trend line, which suggests, we still have a lot more room to go. The only thing that I'm kind of considering here is this RSI print of 80.24, very, very frothy. But we've seen that RSIs can hold frothy for a very long period of time. And we did break through this resistance. A couple week close would signify that this would mean a little bit more, right? Because we just had 1 week close so far. But if we get a full weekly close out of it too, that would suggest that this is a very, very true breakout, and we have a lot more room to go to the upside. So this is really helping that energy sector take lead. So Still a lot of strength and energy. If you can find some good opportunities in there, all the best. Here's the weekly time frame for CRB. You can see here we broke out of also a multi-year trend line, and we broke out of this resistance. We've held above there now for a couple of weeks. RSI, that's the only thing, right? It's very, very frothy as well. This suggests, maybe we come back and back test it and move higher, or we continue to run up higher. This is the market pricing in higher inflation, but this move is just, that is being taken. That's what's going on here, right? So from November to where we are right now, this is just a vertical line moving up. So insane move in commodity index. Let's look at gold and silver really quickly. Gold, very important key level to hold around here. Right? We're at the 61% retracement level from this March bottom. And, that's right around 1692 to 1650. So we got to hold these levels, or we have definitely more downside to go in the price of gold. Still overall, structurally speaking, it's still structurally sound. This is a long period of consolidation. And as the 10-year yield continues to move higher, pricing in higher inflation, you would think, gold would benefit from price in higher inflation. But you can see that as real yields continue to rise, gold continues to head lower. Silver, on the weekly time frame, still hasn't quite hit the price target that we matched in at the 38.2 retracement level, but still shows the opportunity for more downside to come. So we got to keep an eye out for that. I am building up a silver position right now because I do think that silver and gold long term will have some amazing upside potential. But like I said, I'm not over leveraged in those positions. Not leveraged at all, actually, in those positions, and they're longer term holds. So I actually buy into these opportunities. I'm looking at down here at 18, and then I'm also looking here right around 24 too as well. So I'll be keeping an eye on those levels. Let's look at Bitcoin really quick. I just want to say we kind of we noticed the MACD crossover down here. We saw it pull back. We mapped out this area of support, bounced from that level. I missed it by a couple $100. Give me a break here. And then now 52,500 is acting as resistance. So if we get above 52,500 for resistance, we can easily go tag the previous all-time high. And if we break above that, we're heading higher. It's simple. Dollar. Now this is getting interesting. The weekly time frame, we got above 92, but we didn't close there. So we had a 92.92 print. This looks like a solid breakout of this falling wedge. Last time we saw this over here, we saw some continuation to the upside, which we need to be very mindful of. If we start getting above 92 and holding it there, you got to wonder, like, the Fed is stuck between a rock and a hard place here if yields also continue to rise. And if they do place a program in place where they suppress yields, Operation Twist, yield curve control, whatever it be, the dollar can easily just turn right back around and start heading lower and lower. So let's keep a close eye here. Still not above that 92 level. You can also see from the daily time frame, we broke above that resistance. You can see we're heading higher here. It bounced from the yearly open. Boom. Rocket shipped up. And we also see right around that time, that's when we're seeing all this volatility take place in the market. So if this continues to get squeezed up higher and higher, and we got to hold a couple of days above 92 just to be certain, because we have the 200 period still sloping down right here. So either this is going to be one heck of a fake out, or this is where the market starts pricing in a higher dollar, and that could put some real pressure here on the equity markets, especially if we start seeing a true breakout where it starts reaching up to like 94, 95, 96. And then also, not to mention the yields, if those continue to rise. It's just a recipe for just a huge shakeout in the markets. Let's look at yields. Yields, 10-year closed at 1.56. 30-year closed at 2.28. Higher lows still. You can see the curve, the 10s and 2s, steepening right here too, as well as at 1.42. So, the 10 years at 1.56, we haven't seen this. This is the highest it's been over a year. It's still relatively low, but the markets aren't used to this gigantic move to the upside here. So this is a very forceful move in a very short period of time in the 10-year yield. And this is why everybody is talking and watching the 10-year yield. This helps the financials, right? I say this often because, they borrow short-term right here. You can see, i.e. customer deposits, and they lend long-term, 10-year, 30-year. So I'm curious to know and interested to know. And I think about this from like a housing perspective, okay? Because we see lumber going crazy too. If 10-year yields continue to rise and you see mortgage rates continue to rise, as well as the price of a home continues to rise, then it's going to price out everyday consumers, because the typical consumer, FHA loans, right? These 3% down, these smaller loans are ways to get into properties. And you see like this, the first time buyer program, I think that Biden's working on, I'm not too sure. I haven't looked too much into that, but there's going to be something that breaks there, because people aren't affording the home, they're affording the price per month. And if those prices per month become too extravagant and they can't hold on to it, well, something's going to give. So either the price of the homes are going to start heading down, or they're going to have to bring these yields back down, which you can see potentially housing prices continue to move higher and higher. So it's just a very, very confusing time right now in the markets, especially when you see these moves like this to the upside. Like our house personally is up like 14% in a year. That's beyond bonkers to me. Doesn't make too much sense. But when you look at the price of lumber, I guess it does make some sense. So overall, just crazy stuff. Went on a rant there. So US 10-year yield, we broke through that area of resistance. I'm still looking right up here as a next key level, which is 1.9 to 2. If we get up there, I still think there's going to be obviously a lot more downside risk to the tech sector, but this is in that zone of resistance. So potentially with a very frothy RSI, this could be an opportunity where we start seeing it pull back or turn around. And if that's the case, we can potentially see gold and silver really take off as they're moving into these key resistance levels, as well as see tech potentially bounce. So that's going to be an interesting play out too. And then we have the 10 to 20 year Treasury bond ETF. I still looking at this hammer candle on the weekly time frame. If we get above that, that can suggest the move higher, which would obviously mean yields come down. We're oversold here, and we're kind of right around that 61.8% 0.8 retracement level on the fib level. So last time we were down at those levels, we saw a pretty big rise too. So this kind of zone is a key level there for the bonds that we'll be keeping a close eye on. All right, everybody, that's all I got for you on today's market brief. Just to kind of wrap up my thoughts, we are at a very interesting key level. Overall, I'm still looking at that energy sector as well as financials, just to find good stock setups overall. But keep in mind, the market is still suggesting high volatility, large range candles, a lot of drama, a lot of emotion that has not slowed down yet. So we're looking at those key levels within our charts to really kind of determine, what might take place next. And it'll set us up for potentially entering into a long position and then hedging out or scaling out. So you got to be very tactical, very, very careful in this current environment, because the market looks like it's going through some sort of distribution phase where it's this argument between the bulls and the bears as these yields continue to rise. So like I said, be tactical, be careful, and we'll see if we get some follow through and continue this momentum either to the upside or the downside going into the next couple of weeks. All right, see you later.